In today's video, we're going to be examining how we can analyze and predict how the stock market will perform after the federal funds rate was increased to a total of 5.25. We do expect the market to be very turbulent, so I'm sure you want to stay tuned. You've arrived at the Financial Almanac. I'm your host, Basil, so let's get started. The Federal Reserve has in total increased basis points by 500 basis points. That's 5% from 14 months ago. That's a lot. That's the steepest growth in the history of the Federal Reserve. The largest growth means this. That's very quick. All right, so if you watched the last video, as I shared with you, the next FOMC meeting is going to be on June 14th. And what will the expectations be for the market? So the stock market is actually expecting that the FOMC will pause and not raise rates come June 14th. There's a 92% chance of that happening. That also means that there's only an 8% chance that the Federal Reserve will cut. I personally don't think that the Federal Reserve will reduce or cut come June. Even though 8% is a very small chance, I just don't see it happening. It's too early. The only way that they would cut is if there's some sort of economic disaster. But I don't see that really happening. So ultimately, I do expect a pause happening in June. So some of you might say, wait, isn't there a chance that the Federal Reserve might increase rates? Yes, there's a chance, a very slim chance. Actually, it's less than 1%. That's how unforeseen this circumstance would be if they increase rates again by either 25 basis points or not. This would blindside the market really because we're not putting it into the metrics. We expect 92 for it to pause, 8% for it to go down. The market does not anticipate it going up at all. Usually Jerome Powell and the FOMC, when they determine the rate, whether there should be a hike, a pause, or a reduction, they usually follow the market. You know what I mean? What the market expectations are. So we highly doubt it because the market would be completely blindsided if they do increase rates. The stock market was really, I wouldn't say disappointed, they just weren't excited because the meeting that took place earlier this week wasn't really dovish, it wasn't bullish. Since they did not mention the word pause for what's coming up in the future in June, they did say this. They said they would determine if additional policy firming would be appropriate. That would give Federal Jerome Powell the ability to see if it's appropriate to pause or to increase. That's why it wasn't bullish. That's why we didn't see the markets rise a little bit because of this sentiment. As I covered in my previous video, they're going to be data determining, meaning they're going to be basically analyzing these next few months leading up to the next FOMC meeting in June 14th, and they're going to see whether or not how to respond, whether to pause, pull back, or unlikely what the market thinks is increase rates again. This is a very reactive state to be in. According to the CME watch tool, this is their expectations. The FOMC watch tool expects 92% there will be a pause, 8% that it will be reduced. But in July is when the market believes 50% chance, there's a chance that it would be a pivot, meaning the rate reductions would start going because market needs to be saved, or something's at least broken in the market that they see that they want to basically support with, reducing rates helps with quantitative easing. The same watch tool is expecting that in September, there's an 80% chance that the Fed pivots. So we can see here that the Federal Reserve and the markets are so far away from each other in their mindset that they might as well be worlds apart. Now, if there's an 88% chance that the markets believe that the FOMC meeting in September is gonna cut rates, this means that's not very good because the market wants to be saved. But Jerome Powell has stated this, that they're gonna hold the rate, right? This is what they're basically expecting. The Federal Reserve wants to hold the rates at a very high rate. The market doesn't want that because it wants to be bailed out. Since Jerome Powell has affirmed that they will not cut interest rates in 2023, how will the market react? So since the market believes one thing and Jerome Powell and the Federal Reserve is saying another thing, the markets and them are not really aligned. I'm going to pose this question to you and you let me know down below if you align with this. Does this mean that the markets lost credibility and faith in the Federal Reserve? Or is it that the market is being very optimistic and want to be bailed out to increase their portfolio? So this is crucial, especially if you're an investor. The Federal Reserve, Jerome Powell, said he's going to hold those interest rates high up there for a while. Historically speaking, anytime there was a recession around the corner and the Federal Reserve increased rates, they held that at a plateau for several months, right? Up to 14 months in some cases. I do expect that Jerome Powell is serious about his remarks that because they hiked, and now they're at 5.25%, he's not going to pull back. I'm going to believe what he said, because even though he said things like transitory and it's not really transitory, he was being he didn't want to show his cards, if you know what I mean. He wants to hold his cards close to his chest so the market doesn't freak out. I do believe him when he said that the FOMC rate of 5.25 is going to be held there for a while, for the rest of this year, at least 2023. I don't see it unless there's something catastrophic happening. But since there's no catastrophe going to be happening that we foresee, I really do take his word. So for example, in 2000, during the dot-com bubble, that recession, the federal funds rate was at 6.5. And guess how many months it plateaued? 7 months. I do believe them when they're going to say they're going to pause. In 2018, the federal funds rate has plateaued for 8 months. But in 2006 and 2007, that plateau was for 14 months. That's why we have to keep in mind as investors, right, that historical data has shown that come June, July, or September, that they might actually pause for a while because things are really bad now. Our GDP to debt ratio is unbelievable. It's 120. It's higher than 2006 and 7. It was higher than 2018. It was higher than 2000. Gross domestic product has never been this high, even in the 40s or in the 70s. It was never this high. So it's a completely different market. This is all brand new. So I really do believe them. It's going to be lasting for a long time. That's the plateau, that is. Not only was the debt to GDP ratio a lot higher today compared to then, our inflation rate was nowhere near back then. Today's a lot worse compared to then. So that's another leg where I believe that the plateau is going to stand up. We're going through the worst inflation phase we've had in the last 40 years. So it's very uncertain how long this plateau or this pause would last for. So I also want to say this, that the expectation that there will be a Fed pivot is actually keeping the treasury rates low. I also want to share this with you because not a lot of people are talking about this. The expectation that there will be a Fed pivot, that expectation alone is actually keeping treasury yields down. Let's look at the treasury yield for 10 years, right? The 10-year treasury yield about 6 months ago was 4.2%. It peaked there. So even though the federal funds rate has been rising since then, the yields have fallen to 3.3% from 4.2. That's not a small amount. What would happen if this actually does go through, the expectation is washed away, and the Fed pivot is no longer an idea that the market wants to grasp on? The 10-year would go up, the 10-year rate, right? And the market would be devastated, right? So that means the stock market would be very depressing to look at. The yields on mortgage rates, right, for lenders would also jump up just as quickly, if not, a little bit more drastic, because of the shock to the system and how many things are leveraged and collateralized in the market. And what's crazy is tech, that sector would be destroyed. So the hope that the Fed would pivot is actually keeping that nightmare away for now. So if that Fed expectation goes away, that they will pivot, the yields on the 10-year treasury and everything that we spoke about regarding how the market will react will slowly take place. All right, so now we're gonna move on to the substitute effect. Before I begin, I wanna make sure that my viewers get this insight that the rate that happened earlier this week, that rate hike was the 10th one in this series, right? And the market really believes that's too much too fast. Because of that, we see banks are failing. We've seen real estate pretty much nosedive. Manufacturing, oh my God, even haven't talked about manufacturing yet. That has been crushed. And we already see that, US consumers are hurting, and it's gonna bring only more pain. Because of this interest rate, a lot of the market really believes that that's just a tipping point and it's going to fall over. Well, I don't want to say that, but there will be an anvil. Let's just say that. An anvil will be dropping. All right, so having laid that foundation, think about this. We have the visuals of a more ominous future in terms of the recession. And we also have the substitute effect. And because of this, we have a very slim chance, almost negligible, that the FOMC meeting that'll happen later on this year, those meetings, the rates are not going to go up again. I think we've hit 5.25 and that's the peak. So the substitute effect is this, that even though the FOMC meetings, we're not expecting the rates to go up, remember in our last video that I also mentioned that the banking economy itself will constrict lending. That's a substitute effect, where by proxy, the retail and the commercial banks are going to be basically doing that same job, right? By making lending a little bit more tighter, hence reducing the amount of liquidity in society and basically contracting the economy. And with this, credit crunch, businesses are not going to be selling as much, right? They're not going to have as many services being purchased. There's not going to be as much hiring in the economy. We touched on that in the employment sector of last video. And that means unemployment rates go up and the economy slows down, if not recedes a little bit. And by proxy, the substitute effect is what the Federal Reserve wants. And that tighter demand for credit and liquidity will actually reduce inflation in society, which is what the Federal Reserve wants. And because the banks are going to be basically doing the job of the Federal Reserve by that credit contraction we just spoke about, that is what we call, or what they call actually, the substitute effect. That's what they're coining it as anyways. So with this tighter credit conditions, it'll actually assist in hurting the economy, but also lowering the rate of inflation. But what is sort of still a mystery is by how much. Powell has said this: the extent of these effects will remain uncertain. But at least this tighter credit condition will be taken into consideration come the June meeting. So in my previous video, I did sort of give my prediction on how I would expect that FOMC meeting to go when they raised rates, and the market, like many people predicted as well, was very neutral, didn't dip too much, didn't jump too much. As Jerome Powell was giving his speech, the markets were muted. But as he took questions after his speech, that's when the market started to have a reaction, right? A slight one, but it went bearish a little bit. It dropped down a little bit. Even though it had that sort of reflex after the questions, overall, it was still muted, right? It didn't really phase anything. And since this was already factored into the market, nothing has really changed drastically. Everything dropped by less than 1%. And the VIX, the volatility index, also was low. In my opinion, this is what I expect coming up. As we know, the Federal Reserve, Jerome Powell, will be watching data and analyzing inflation and other factors that will lead up to the June meeting. Even though, CPI is important to them, they will also look at PCE. And by then, the jobs report will also have come out. For June's meeting, they will be relying on this month's data, on May's data. And since they're the Federal Reserve, they'll have access to that information before the public regarding the jobs report, CPI report, PCE report of May before their announcement. With regard to the CPI inflation report, they'll have the core inflation report one day before their meeting on June 13th. And even though the public will receive it on June 13th, one day before the 14th of his meeting, he does have access to that information leading up to the 13th. So we'll catch up with what he already knows. Unless there's a huge spike in inflation, the Fed will be pausing in June. And regarding the Fed pivot, the Federal Reserve and Jerome Powell, they don't want to pivot, right? They want to hold that plateau for several months until at least the end of 2023, as they have shared with us. But the market is skeptical. The market finds that they're going to call their bluff, right? They're going to call the Jerome Powell's bluff and say, hey, we actually think you're going to pivot in 2023. So if the market thinks, close to 90% that the Fed will pivot by September, what does that mean for us? Who's going to win? It's basically, what is it, chicken? When two cars come at each other and the first one, it's basically a game of chicken between the market and the Federal Reserve and and their subsidiaries of banks. I personally find that there won't be a pivot in June or July at least. And depending on the data that we see, maybe they'll be in September, but I still think that might be too early, but who knows? But I do believe that June and July is way too early, right? And the only reason the Fed would really pivot, according to what they said, is one of few reasons. Is, so one of the big banks, right? They show signs of turmoil and distress, or the service sector has a crazy inflationary expectations they didn't see coming. But if a mild recession is what they expect and it's what we go through, right? I really don't think it's gonna be mild. Then they're not going to raise rates, right? They're going to hold it until CPI, inflation specifically, is at 2%. Personally, I think the markets are going to slowly still edge up to July. If things get pretty bullish, then maybe August. But after that, I do see in my charts, using my technical analysis, that the market will regress and break down, and it will be another 50% drop. Unfortunately, it's going to be pretty bad. So, take some profits on the way there. Don't wait and be greedy to take the profits when it's up there. If you've invested in the past when the market was down, slowly, take up some profits, have some liquidity on hand. Look at major dips in commodities as, natural gas is pulled back. If uranium pulls back, that'd be nice as well. Oil has pulled back severely, but I would still wait on that a little bit. I'm still a little bearish on that. There's going to be opportunities where you can buy the dip, especially if gold and silver retrace. I can get into those TAs later on. Let me know if you guys want to see that. But right now, we're still going to be covering fundamental and sentiment analysis. Times like this has never been sort of faced by our economy and our society, the modern age. And because, debt to our GDP is crazy, our rate of inflation is crazy, things are going to get worse. I do believe that. So let's take some profits while we have them. If we miss a little bit extra, that doesn't matter because you have some liquidity. There is a credit crunch coming right after this inflationary period. You want to make sure you're able to have some liquidity, at least not for living expenses, but also to invest and buy the dip, right? It's going to be wild. It's going to be crazy. But, considering everything, we have to stick together, still show compassion with one another as we, proceed in the unforeseen world that's going to be the rest of 2023. We do see central banks going crazy with their rates, banking collapses here, there, and the other spot. I don't even want to think about what's going to happen with Deutsche Bank in Germany or Credit Suisse in Switzerland. It's going to be a wild ride for sure. So make sure you are your own bank. Look into commodity. Usually during times like this, there is a peak, but take profits in these commodities if you already entered a trade. So to continue where I was alluding to, I do expect continued economic sort of degradation come the beginning of Q3, maybe by the end of this second quarter. I expect QT as well, quantitative tightening and increase of unemployment rate to go up. In addition to all of that as well, I do expect corporate profits and earnings to drop, thus leading to tightening credit conditions. But overall, I do anticipate in Q3 is when all the fireworks happen. So overall, if you are an investor, make sure to take some profits and stay liquid, because you might want that for the bargain, you know what I mean? Thanks for staying with us over here till the end. If you like, make sure to hit that like button. If you haven't yet, subscribe, and I'll see you guys in the next video. Bye-bye.